You've been to plenty of these conferences here. A lot has changed, I think, I'm pretty sure, over the last few decades. I think a lot has probably changed just in the last year alone.
Oh, that's for sure. I mean, if you look at people's focus this time, debt has really come to the fore. It's awfully difficult to be interested in buying debt securities when base rates are zero, spreads are zero, and covenants are zero. And it's also difficult to buy equities and other things, but the momentum and the upside optionality on those securities maybe propels people to do more than they should there. But when things come crashing down, things are very different.
A lot of people have talked about the cost of financing given the rise in interest rates, but more importantly, how you sort of map out what the return is that you need for yourself and, of course, for your investors as well.
Well, clearly that hurdle has gone way, way up, which is, I think, terrific news. There's just such a broad array of things to do. The big news is that with the enormous growth in private equity, the enormous explosion in real estate prices as well, you've had both in the corporate world and in the real estate world an abundance of balance sheets that really weren't created for higher interest rates. People built things with higher and higher multiples of EBITDA in terms of debt. Interest coverage was quite small, and instead of being able to fully grow into those balance sheets, there was a 2-year interruption, often in revenues, with COVID.
Right.
So as those balance sheets start to mature, I think a lot of private equity sponsors have some hard decisions to make as to how to reconfigure those balance sheets.
But there's a big question here about that bridge, the idea that maybe this is a bridge to nowhere, at least for certain pockets of real estate, commercial real estate.
I think corporate and real estate are different. I think there is an abundance of high-quality corporate issuers that just have a little too much debt that will figure out a way, in spite of the debt dropping in price, to find their way through, and the sponsors will support those situations, et cetera, in most cases, or at least move fate down the road. Real estate is a different story, and I think real estate, you have to be very sensitive to the product type. We've all seen the flight to very, very, very high quality, while lower quality office has become, in some cases, worth less than the ground it's built on. And so changing purposes of real estate, which COVID maybe made us aware to, changing migration patterns have created winning and losing marketplaces, and changing product types, as I said.
Well, how do you adjust to that? Because we talk about, for example, the real estate market. Like, what's happening now isn't just about an economic downturn. This is a major structural shift in how we work, where we live, et cetera, et cetera. How do you adjust around that or find opportunities around that that are safe relative to the risk that you want to take?
In the beginning of any downturn, the first thing that comes to light are the worst problems. So that's why you're seeing B office buildings that were that had a $600 million valuation or a $300 million valuation being sold for maybe 50 or 60, and you're told that in order to re-tenant that building, if you can do it at all, is going to cost another $50 million. So these things are there's going to be carnage in certain parts of the commercial real estate business. On the other hand, you can take assets that are very high quality, fully occupied residential real estate in apartment buildings in excellent growth markets, but they still have balance sheets that were not built to last because interest rates are literally twice as high as they used to be. So when it comes time to refinance, if they do have near-term maturities, or if they're new buildings that have just been completed, the debt balances that are going to be sustainable on those buildings can be much, much lower, and that'll require a lot of creativity and a lot of plugging of holes in balance sheets that I think are opportunities for alternative types of debt players.